You're listening to Ask the Expert on Sprott Money News.
Hello and welcome to this month's Ask the Expert here on Sprott Money News. As usual, I'm your host, Jeff Rutherford, and on the line with me today we have Mr. Rob Kirby. Rob Kirby spent the majority of his career working in financial markets, where he honed his skills and knowledge on precious metals, foreign exchange markets, interest rate derivatives, and government bond markets. He's also become one of the most sought-after writers and speakers in his discipline and writes for many respected online publications, including La Metropole Café, Financial Sense, Silver Doctors, and Safe Haven. His website, kirbyanalytics.com, has become a valuable resource of knowledge to those seeking the truth about financial markets. And with that, I'd like to welcome Mr. Rob Kirby. Good morning, Rob. Thank you for joining us here today.
My pleasure to be with you.
Now, Rob, before we get started, I think it's important that we kind of discuss your background a little more. From what I understand, you were not a believer in financial market manipulation at first. Why was that, and why did your views change?
Okay, the reason it was, I spent roughly 15 years in institutional brokerage markets when I left university, and I went to university at York University in Toronto. And when I went into the institutional brokerage markets, I started off in foreign exchange. I didn't stay in foreign exchange very long, maybe 9 months, and then I was shifted into Canadian money markets, spent a couple of years there, shifted into U.S. money markets, and that's the time frame when interest rate derivatives, specifically FRAs and interest rate swaps, were being incubated, and they were largely incubated in Toronto, Canada, by American banking institutions, specifically the three institutions that really did the legwork for introducing the interest rate derivatives to the market were Citibank Canada Toronto, Chase Manhattan Toronto, and Chemical Bank Canada Toronto. They were really the originators of the lion's share of today's derivatives markets. I mean, people throw around and bandy about huge amounts in the hundreds of trillions, or 1.5 quadrillion globally, but big numbers for total outstanding derivatives. Just be aware that 80% of whatever totals people are throwing around, 80% of those are interest rate derivatives, and the very instruments that were created right here in Toronto, Canada. So I spent the remainder of my institutional years in the basically or predominantly in the brokerage of the FRA, U.S. dollar FRAs, and U.S. dollar interest rate swaps. From there, there was a logical progression to move into bonds, because embedded in interest rate swaps, 3 years to 10 years in duration, there is a cash bond trade. And not strangely, the firm that I was working for doing these interest rate swaps opened a bond desk, which I was instrumental in opening, and that would have been roughly 88 or 89. And so that's sort of my progression through the markets, and I got out of them mid-90s. And my biggest client through the heydays of doing this that I did in terms of the interest rate derivatives, swaps and FRAs, my biggest client was Citibank Canada Toronto, who hands down was the biggest interest rate derivatives player in the world over that time frame. And Citibank Canada Toronto also served as the clearinghouse for Citibank worldwide in those instruments through that time frame. Subsequent to all this, because it was early in the 90s when Citibank New York repatriated the U.S. dollar derivatives book from the Toronto subsidiary and repatriated it back to New York, which was a big loss up here in Canada. But it's not really surprising that when one realizes the power of these instruments to influence markets, that it wouldn't be repatriated back to New York, where, let's just say, more powerful eyes have control of it.
So, Rob, let's take a look at some of the questions we have here from our listeners. Firstly, let's take a look at a question in terms of talking about the paper markets. So first question is, Rob, do you think anything can shatter the banker's chokehold over these paper bullion markets other than some default-like event?
My best guess is something is going to shatter their chokehold, and it's going to be the ever-growing demand for physical metal and increasingly going forward, people who want exposure to precious metal are going to be realizing more and more that owning GLD and owning SLV, they're not really gaining real exposure to physical metal. And when I speak of paper instruments, I don't want to throw the Sprott funds, which I believe to be true holders of the physical metal they purport to have. My own personal opinion is that the likes of GLD and SLV do not hold the metal they purport to have, and I'm also not a believer that the stocks that are reported to be in the inventory of the COMEX, whether it's registered or unregistered, I don't believe they really possess the metal that they claim to have either. And any metal that they do claim to have in their possession, I don't believe it's really for sale. So, yeah, I do think the paper markets are headed for a Waterloo, and I think the Waterloo is going to come when demands for physical metal overwhelm paper, and when somebody who's large enough is denied a physical delivery of an amount big enough that they effectively blow the whistle on the system.
Now, likewise, Rob, kind of keeping in mind with the idea of a financial crush, one of our listeners would like to know, when talking about the upcoming financial crush, experts tend to focus on the United States and Europe. Can you provide some perspective on the effect of the crush on Asia, Australia, and other countries in the Pacific region?
Well, the effect of a financial crush, which I believe has already begun, I think it actually began last week when the Swiss National Bank dropped its peg to the euro at 1.2 Swiss francs to a euro. And I believe that this has set in motion a wave of events that's going to basically draw in all nations around the world. And the reason for this is because no country in the world is currently on a precious metal standard. And effectively, all fiat currencies around the world are really nothing more than derivatives of the U.S. dollar. And I certainly think the U.S. is going to be swept in what's coming. And just as a bit of a background, I'd like to say, in my view anyway, what precipitated the Swiss National Bank's dropping of the peg last week is all because of what's likely coming tomorrow, which is Thursday, and where everybody widely anticipates that the European Central Bank is going to announce a round of quantitative easing. And it's this quantitative easing that's going to put the euro under severe pressure. I think that the Swiss National Bank was front-running their advanced knowledge that this was coming. And if people didn't notice it last week, the European Court of Justice basically green-lighted the ECB's ability to do QE, and the European Court of Justice's decision to green-light QE flies in the face of a earlier decision, which I believe about 2 years ago, the German Constitutional Court said that such QE would be in direct contravention of the German Constitution. So I think going forward, we're set up in short order after an announcement of QE tomorrow. I think we're going to be set up for some severe negative fallout regarding Germany, and possibly, and quite likely in my view, Germany making sounds about leaving the euro.
So let's take a look now in terms of a very popular topic, Rob, that's been coming up as of late in regards to a debt jubilee. So the question is, can debt jubilee be avoided? If not, is there any reason or justification for postponing default on our massive sovereign debts?
Wow, that's a really big question. I mean, historically, debt jubilees have occurred because the whole notion of debt jubilees only speaks to the very nature of the unsustainability of fiat money in the long run. The very design of a pure fiat money system with compound interest dictates that the currency has a lifespan. And basically, through the life of the currency, in terms of its supply, you reach an inflection point where the supply of money has to grow vertically, which is where we're at right now, where money supply is growing vertically. And when I speak in terms of money supply growing vertically, I don't want people to get caught up with the silly notion that they look at the Fed's balance sheet in isolation. The central banks acts as a gang or a gang of thugs, as I'd like to say, and you can't look at any one of the balance sheets in isolation. You've got to look at them in totality, and because this money creation wheel that we're on is really more like a relay race, where the Fed inflates and prints. And then they start to talk. People get worried about the amount of money they're creating, and then people will get tricked into thinking that they're going to end QE1, but the baton only gets passed to the next central bank, which would be maybe the Bank of Japan, and then they print like blazes, and now the baton, it seems, is going to be passed to the European Central Bank. But anyway, money has to grow. The money supply has to grow, and will continue to grow vertically, and at some point it becomes sort of a showdown internationally around the world, sort of like the old saying about the emperor has no clothes. And at some point, people will realize with the fiat money system globally that the emperor is wearing no clothes, and they're going to demand real stuff. And I think we're starting to see this thought gain traction with people around the world demanding physical metal, and countries around the world asking for repatriation of sovereign bullion that's being held by others around the world.
Excellent, Rob. Now, moving over now to a question, I guess it's more in regards to whistleblowers, more or less. So last year, was the UK trader or whistleblower telling the truth? In that, is there a way of finding out who massively shorted the gold if it was shorted? And likewise, if it was from outside the government, shouldn't the government have stopped it?
Well, my view about who shorts the gold is that this shorting of gold, in my view, is all orchestrated by the U.S. Treasury. And specifically within the U.S. Treasury, there's an adjunct of the U.S. Treasury known as the Exchange Stabilization Fund, or ESF for short. And the ESF is an institution that was created in 1934, and it was created at the same time when the U.S. government confiscated gold from American citizens and then quickly revalued it upward, and creating a huge capital gain or windfall profit. That windfall profit is alleged to have been around, I think, in the $2 to $3 billion range in 1934 dollars. It was that money that was used to seed this ultra-secretive adjunct of the Treasury called the ESF. That served as the working capital. So, and understand, everybody, that institution, the ESF, took that two or $3 billion in seed money in 1934, and they have been growing that money, operating it as they see fit, with absolutely no oversight. They do not answer to Congress. They do not publish annual financial statements, and they're free to operate in any market, and they operate above any and all laws in the United States. So, just think about if you take the annual reported inflation rates, and if you had actually just taken $3 billion and been rolling it at 3 or 4 or 5% for all those years, what sort of amount of money you'd be have at your disposal. And this is all off balance sheet, because you see, this doesn't come on the books, the visible books of the U.S. Treasury. And so the amount of money that this entity, the ESF, has is absolutely and utterly scary, and I reckon it is absolutely, hands down, the most powerful financial entity on the planet.
Well said, Rob. Now, Rob, moving along here, the question now is kind of around the idea of asset prices. And the question is, how can we estimate a rational price for various goods and assets when asset prices have been skewed so severely through manipulation that we no longer have any reference points to use in pricing assets relative to each other?
the question you ask is an extremely good one, and it's a question that I would suggest might be better put to the likes of Mr. Kevin Warsh, who is a former member of the Federal Reserve Open Market Committee. And Mr. Warsh, after leaving his position at the Federal Reserve, he penned an essay which was published in the Wall Street Journal, and he called it "The Financial Recession Trap." As a subheadline, in capital markets worldwide, policymakers deliberately obscure market prices and prevent informed judgments. So Mr. Warsh is an insider. Mr. Warsh attests to the fact that central banks are not just in the precious metals market, not just in the energy market, they're in all markets. They are arbitrarily setting the prices of energy. They are arbitrarily setting the prices of capital through interest rates or the price of bonds. They are arbitrarily setting the price of precious metals because precious metals are a natural alternative to their fiat currencies, which they print at will. So, what is the true value of an ounce of gold or an ounce of silver? I'm gonna refer to it this way, if I may. I take the last 3,000 years, roughly. I put it on a yardstick. I ask myself, for the greatest amount of that yardstick, what served as money? And if you take the last 3,000 years and you put it on the yardstick, for about 32 inches of that yardstick, somewhere between 40 and 60 ounces of silver was a solid upper middle class wage. So my question back to you is, you tell me exactly what you consider to be a solid upper middle class wage today. And if you're like me, you're going to probably say it's around $50,000 to $60,000 a year. And, some might have a different number. And then I'm just going to take $50,000 a year, and I'm going to divide that by 40 ounces of silver, and you tell me what an ounce of silver should be worth. And the funny thing is, it's a pretty big number. And it's actually a little bit over I believe around about 1,000 anyway, or more than $1,000 an ounce in today's dollars. You see, what this is reflective of is the scarcity of precious metal in the Earth's crust relative to dollars that can be created at will and out of thin air. And while this might seem like a huge pronouncement on my part, all I'm going to say to you and ask you to consider is that if we move back to silver being worth that amount of money, that is nothing but a reversion to an historical mean. And it's only the last 200 or 300 years that we've really broken away from that historical mean. And a movement back towards those levels would be a reversion to the mean, and I'm a big believer in things that get stretched reverting to the mean.
Excellent, Rob. Now, Rob, I guess kind of tying into that now, looking at what's been happening in regards to, oil prices and currency wars. In a time of currency wars and oil prices collapsing, for those holding physical gold and silver in our possession, how can we respond? Will this event instantaneously create a black market where people buy, sell, and trade amongst themselves with gold and silver? What alternative will we have?
That's another really, really good question. Are we going to be meeting people in dark alleys to trade bullion? I don't think it's going to get to that level, but what I do see going forward, very likely, is your local coin dealer might have more of a banking function in our very near future than it has in the past. But I don't see how governments are going to be able to outlaw, because a lot of people have thrown that at me. Do you think governments will confiscate precious metal again, as the Americans did early in the 1900s? I don't think they realistically can. We've got the biggest countries population-wise in the world, India and Russia, encouraging their people to buy and hold physical precious metal. And frankly, I don't think America has got the. I don't think America has the prestige anymore, because American prestige in the world has been squandered with through imperialist hubris, and probably bigger than that, what America has spent more than maybe wrecking their currency and more than maybe getting rid of all their gold, which a lot of people don't really think they have anymore, me being one of them. What America's really done is they've abdicated the moral high ground. And when you don't possess the moral high ground, your high-handedness or your ability to impress upon the rest of the world what the right way is, you lose that ability. Mm-hmm. And American prestige has truly and utterly taken a pounding, and I don't think they're going to be able to gain it back. So no, I don't think they're going to be able to make owning gold illegal. I don't think they're going to be able to outlaw its trade. But what I do see coming to an end are the paper games, and I do think gold will move to the point where the gold market will be cash and carry. And there won't be paper games.
Now, we've kind of expanded about America and the effect of the United States on the global economy. So let's kind of switch to Canada. Compared to the rest of the world, how will Canada fare during the collapse and after? Likewise, how long do you anticipate the recovery period will be after the crash? What will a post-collapse recovery look like?
Let's see. Going forward in Canada, my best guess is we see our currency. We've seen our currency taking a complete and utter kicking with the collapse in the oil prices. But on a go-forward basis, Canada produces a lot of stuff that the rest of the world needs. And, when we have a collapse, commerce isn't going to stop. It's just that the way it's transacted is going to change. So Canada will, in my view anyway, will continue to have things that the rest of the country needs. Other countries will want to trade with us on a go-forward basis. But our dollar might even come to pass, because my view is the U.S. dollar is going to come to pass, and my view is that there will be something that replaces the U.S. dollar that will very likely be commodity linked. And when I say commodity linked, I think gold and silver are very likely to be at the center of our package of commodities that back currency. So I don't see Canada as being as fractious as the United States is likely to be with a breakdown, because Canada doesn't have quite the experience of America in terms of gun ownership. Canada seems to be a little more, I want to use the word civil, and I don't even know if that's the exact correct word, but we have traditions that I think should leave us in maybe quite possibly better stead than America. I would say we will suffer, but I don't think we're going to suffer as badly as America. I think Canada's likely to stay together politically, where I think there could be fractures in the American Union. In my own view, I think America is ripe for a civil war. I don't think we're going to have a civil war in Canada. We could very well end up with a refugee crisis on our hands in Canada if America breaks into a civil war. And I think there's a lot of internal difficulties in the United States relating from, in my view anyway, a failed immigration policy in America that has basically left the southern border wide open for years, and the very well known issue of undocumented immigrants in the United States. This is the recipe for a civil war, in my view. We could end up with a refugee crisis in Canada where millions of Americans are fleeing to get up here. Anyway, I think our prospects are better, but I don't think it's going to be easy times for anybody.
Excellent, Rob. That's a very unique perspective. I haven't heard anyone come from that angle. Now, kind of moving along now to derivatives, actually. The question is, if a counterparty defaults, a derivative stay appears to protect collateral of a bankrupt counterparty and prevents the winner of the bet from going after the collateral. If both the winner and the loser of the bet are bankrupt, the winner cannot terminate the contract immediately, nor go after the collateral. So do derivative stays create an environment that is more likely to dissolve trust than no stay at all?
That's another good question. I'm going to characterize what I think is going on in the derivatives world myself. If you're going to really talk intelligently about the derivatives market, you have to, like in the American sense, for instance, American institutions or bank holding companies are alleged to possess around $300 trillion in derivatives. 98.6% of them are held by 5 institutions, specifically J.P. Morgan, Citibank, Bank of America, Goldman Sachs, and Morgan Stanley. So those 5 institutions hold 98.5%, or like almost 100% of all the outstanding derivatives that are held by American institutions. So what you're really talking about when you talk about the likelihood of a failure or a collapse or a default or a bankruptcy of one of these institutions, you're really talking about the likelihood of those 5 institutions collapsing. It's my view personally is that Morgan Stanley was insolvent back in 2008. They tried to marry Morgan Stanley to somebody. There was nobody in the world that would take Morgan Stanley on. J.P. Morgan didn't have the capital, in my view, to absorb Morgan Stanley, as they had absorbed Lehman Brothers and Bear Stearns. And there was no other dance partner for Morgan Stanley. So in my view, what very likely occurred back then was the law that exists on the books where people in the executive of the United States can grant a publicly traded company a waiver where they don't have to have accounting, where they're excused from their SEC obligations of reporting their true financial state. This law is on the books. This law was in motion in the time frame after 2006 because the authority to implement it was transferred in the spring of 2006 to the then intelligence czar of George W. Bush, who at the time was John Negroponte, where the intelligence czar in the United States was granted that ability to basically waive publicly traded companies' requirement to report their true financial condition if it was in the name of national security. So that law is on the books in America. There's no doubt in my mind that law was in play in the 2008 timeframe. I absolutely suspect that Morgan Stanley was on the receiving end of it. I think there might have been others that were on the receiving end of it as well. And so my question back to you is going to be, if any of these institutions that we're speaking of, if any of them can be insolvent, but they don't have to declare it, how would we ever know?
How would we ever know? It's a very good question. A very good question. Now, here's another question, Rob, that it's actually a very common question that some of our clients give to myself and likewise pose to Eric as well, too. And the question is simply, where is a safe place to have your money in case of a bank run?
The answer to that question is simply not in a bank. And I don't consider fiat money to be real money anyway. In my view, real money is gold and silver. And my view is to, have your money in the form of real gold and silver, and have it in your possession, and use your imagination as to where you hide it, or where you keep it, or where you store it, and just make sure you don't tell everybody in the world exactly where you put it. And if you're going to entrust it to anyone, make sure you know who they are, and make sure that you trust them.
Are there any particular countries where you think it would be better to store, for example, your precious metals more so than America, for example?
For me personally, I would say at the top of the list probably is Canada. I'm not very fond of what goes on in Switzerland these days with regards to the storage of metal. I've heard some horror stories about people who've had what they were told or what they believed to be allocated metals held in Swiss financial institutions, which wasn't there when they went to get it. So there really aren't many countries that I think are great, but I'd say Canada probably is as good as any place. But ahead of even that, I would suggest your own possession. whatever jurisdiction you're in, your own possession, and use your imagination as to where you can store or hide something. But I'm a believer in people empowering themselves. If you've got something that's worth owning and worth, find a good place to hide it.
Now, likewise as well, Rob, I guess looking at recent movements of gold and silver prices and being aware of obvious precious metal manipulation, what is your short-term outlook for precious metals in terms of gold and silver?
My view in the immediate term is explosive to the upside, particularly with the fissures that seem to be developing in the central banking community and what I see as a very fractious go-forward situation developing in Europe. Vis-a-vis what the Swiss have done, what I believe the European Central Bank will announce tomorrow, and what I believe will be a German response to that in the coming days.
Well, Rob, we'd really like to thank you for joining us today. This has been a phenomenal interview. I'm sure our listeners will get some great insight into what you've discussed with us today. Again, we've been speaking to Rob Kirby, and we invite all of our listeners to go to kirbyanalytics.com and hear what Rob has to say in regards to what's been happening in world markets. And again, Rob, we'd like to thank you for joining us here today on Ask the Expert on Sprott Money News.
Been my pleasure.
Wonderful. And this is Jeff Rutherford for Sprott Money News. You've been listening to Ask the Expert. Thank you for listening. Have a great day.